Assalamu alaikum everyone. So today we are going to be looking at private limited companies and public limited companies. Previously we talked about sole traders and partnerships. Those are the unincorporated business. Over here we are going to be talking about incorporated businesses. So let's begin. Private limited companies are small to medium sized business, incorporated business. These are incorporated business as opposed to that sole traders and partnerships. This means that they have separate legal identity, they have continuity, and the shareholders have limited liability. What are shareholders? We've discussed that any individual who has a share of a company, share means that they have part ownership, they have certain rights, and they get dividends from the profit that the business makes. So privately limited company is a small to medium sized incorporated business. It is owned by shareholders who are known to each other, usually friends and family. There's not one individual, there are no partners, these are shareholders. Since the company is registered, it's like they have their own trademark name which can't be taken by some other business. They have separate legal identity. Business is treated as a separate entity. So friends and families, those people that who are known to each other, they have they are called shareholders, not individuals, not partners. They are shareholders. So this activity, this business activity is usually commenced between friends and family. If you know some friends, you know some family members, you say, okay, let's start this business. They all work together, they all invest in this business, and then set up this business. So capital can be raised from friends and family. When we say friend and family, that doesn't mean something like 20 numbers. Like somewhere in books that they say that the maximum number is 50. So 50 is not a small number, it's a huge number. So imagine getting capital from 50 different places as opposed to one place in sole traders, or 20 places maybe maximum in partnerships, 50 people. So yeah, that's a huge amount of capital which I'm generated in private limited companies. That's one of the biggest advantages they have over sole traders and partnerships. They also have greater status as compared to partnerships and sole traders. They are more, since they are registered, they have trademarked, they are owned by more people, so they have a greater status in the eyes of law, in the eyes of government, in the eyes of banks, loans, investors, suppliers. So they can have good suppliers. Banks are also not that reluctant to give loans. They can easily get access to banks over loans and even overdraft facilities if needed. Now, however, of course, they have some disadvantages as well. Drawbacks: shares cannot be sold to the general public or on stock exchange. Whenever you say shareholders, they are only between friends and family. You can't just sell it to direct public, general public. You only sell it to your own your members and family members, and you need consent of existing shareholders to bring more shareholders. If you want to bring more shareholders, you need to first need consent of all the existing shareholders that are currently in the business, that if they give permission to allow more shareholders to come, because if more shareholder comes, that means there are more dividends, and that might mean more responsibilities can be divided, but that means the basic drawback is that profits will be divided as well. So, and the ownership will also divided. So there is a loss of personal control, loss of not there's already loss of control, but still the people who own the business have retain the majority of control of the business, because the shareholders are limited. And another disadvantage is that they have legal formalities like memorandum of association and articles of association. So in sole traders and partnerships, we don't have many legal formalities. Neither do we have to you don't need consent of other people in sole traders, but over here you need consent of the other shareholders. And if you want to bring more shareholders, you need more investment, but you need, in this way we can get more investment, we can get more finance, but as I said, we need consent of other shareholders, so that becomes an issue. Other than that, there are not many disadvantages that have. They are pretty much better than sole traders and partnerships in terms of finance making and status, but the only drawbacks are the legal formalities and the shares that they can't sell more shares to public. This advantage is because it's compared to public limited companies, not the partnerships, not the sole traders. You're comparing this to public limited companies because sole traders and partnerships, they don't have shares to sell. So that's about private limited company. They are medium-sized incorporated business owned by shareholders, which are known to each other. They have separate legal identity, quantity, and limited liability because they are incorporated business. They can raise sufficient capital from friends and family. They have greater status, so they can get more loans easily. And the shares, however, cannot be sold to direct public, and you need permission of existing shareholders. There are some legal formalities involved as well. So let's talk about public limited companies. Public limited companies, people generally get confused with public limited companies and public sector. So please know that public sector is compared with the private sector. Private sector, there's public sector, and public limited companies are part of private sector. These are part of private sector, not a part of public sector. Or don't confuse them with public sectors because many candidates make this mistake and they lose marks when you are asked to define public limited companies. They give the definition of public sectors, which is not the correct definition. They both are very different terms, so please be careful about that. Now, what are public limited companies? These are limited companies means that they are part of the private sector, but public means that there is some government intervention. There is more publicity. So what I mean by that is that there is an ease of buying and sharing of shares. Public is involved. You can sell it to direct public, general public. So it's easier to sell and buy stocks, shares. So it's a medium to large incorporated business. It's not a small because there are a lot of investment involved. There's a lot of capital involved. Legal formalities are involved. So that's why it can't be a small business. It's generally a medium or large business. It is listed on stock exchange and shares can be bought and sold by anyone. By anyone, I mean by anyone. It's not necessary that you need to be a friends or family. It could be a random person as well. The general public, that's the whole idea behind it. It's a public limited company. Public can buy and share shares. Buy shares. So sorry for that. All shareholders have limited liability, continuity, and separate legal identity. We have discussed this earlier. It's part of the incorporated business idea, and it is easier to raise substantial capital from existing and new investors. So they are able to raise finance by issuance of shares. That's one of the key difference between public limited company and private limited company, that they are able to sell shares to general public, and hence they are able to get more. They are able to raise more capital as opposed to private limited companies. So that means more profit and more reputation, more publicity. The thing is that this raising finance by issuance of shares, this will come in a sources of capital when we are going to be discussing that in chapter 5, in unit 5, finance, where we'll discuss different sources of finance. And this source of finance, issuance of shares, this is only valid to public limited companies. No other business can raise finance by this method. Only public limited companies can raise finance, so that gives them a unique image, you can say. Now reputation improves as they have a prestigious profile. They usually find it easy to get loans. Not even loans, they can get overdrafts easily. Overdrafts are basically a short-term agreement where a business can get a large amount of money when they are in need, whenever they want, and that generally has a high rate of interest, but that is useful at times of recessions, when economy goes into recession. So that can be helpful for such large businesses to survive. Now they are also able to gain more time for payment to suppliers when they need when they are a little out of cash sometimes, or they are difficult situation. They can ask for delayed payment of suppliers, because suppliers are more keen to be in business, in to have business with activities with businesses which have more reputation, such as public limited companies. and it also makes marketing a lot more easier as compared to sole traders, partnerships, or private limited companies. They have their own name, public limited companies, because they are medium large in corporate business. They have a big name, and it makes marketing a lot easier. There's a good word of mouth, suppliers, banks, they all help to market the business, to advertise the business as well. However, since there's more media exposure, that means there's greater transparency, and accounts also, the accounts of the business that need to be published and audited. Information on performance should be provided for investors and other stakeholders. That means that you have to give the information to the general public. There's not, you can't hide your information from competitors. You have to publish your accounts, you need to give published accounts, you need to get your information audited and then provide it to investors or the stakeholders, because they need it. They need to know the worth of the business before they invest into the business. So that's why you need to publish your accounts, but that means your competitors also can see your performance, what you're investing in and stuff like that. So that becomes an issue. And another issue with public limited companies are that since they have a lot of shares, you can get finance, raise finance by issuance of shares. This also means that if more than 50% of shares are sold, there's a diverse between ownership and control. That means the basic idea behind this is that the person with more shares gets more authority over it. So you need to hold at least 50% of shares. If you lose, if more than 50% of shares are sold, that becomes an issue, because even though you are the owner of the business, the main owner of the business, you lose control over the business, because there's a democratic system, you can say. So each shareholder gets a say on how the business is being run. So their opinions are given more. The one who has more shares whose his opinion is given more importance. And there are more legal formalities in addition to memorandum of association and articles of association. There are not just these formalities, there are more legal formalities that need to be met, such as these published accounts and stuff like that. So you need to hire counselors and advisors when you are formulating these documents, and that means more cost. There's no control over buying and selling of shares. That's the main hindrance. Over there you can decide with your existing shareholders if you want to sell shares or not. Over here there's no control, you can't control over that. So majority shareholders, as I've discussed earlier, that shareholders having a higher percentage of shares have a greater say on how the business is run. You can't, even if you are the owner, the main person who brought up the business, another person comes in, they buy more shares than you, then they have a greater say on how the business is run. So that becomes an issue. That's all about private limited companies and public limited companies. Thanks for watching. Allah Hafiz.